Welcome to this Getting to Big Checks panel. We have three great investors from later stage clean tech funds. Let's start with Jeff Johnson. Based in San Francisco, Jeff Johnson is a managing director at Temasek, where he leads high impact and emerging sustainability initiatives. He has worked and advised and raised capital for numerous sustainable startups, as well as advised multiple large corporations and investment firms on sustainable investing. Jeff also works in an innovation BD for executive committee at ABB between 2012 and 2014. Before ABB, Jeff worked at Better Place, an electric vehicle startup from 2008 to 2011, overseeing equity and debt financing. Jeff began his career at Intel in 2001 as a data science engineer focusing on software development. Scott Jacobs is the CEO and co-founder of Generate, a leading sustainable infrastructure platform delivering affordable, reliable resource solutions to companies, communities, and cities. Prior to Generate, Scott co-founded McKinsey's clean technology practice, advising companies, institutional investors, NGOs, and governments around the world. Prior to that, Scott spent over a decade in technology and venture capital. Scott has dedicated much of his professional life to the resource revolution and is a regular writer, keynote speaker, and conference panelist on the topics of thematic investing and climate and resource-related innovations. And last but not least, Gabriel co-founded Prelude Ventures in 2013 after almost 25 years as an investor, entrepreneur, scientist, activist, and ski bum. But before launching Prelude Ventures, Gabriel spent 4 years as an investment banker at Deutsche Bank and its solar and semiconductor groups. He was also an early employee at venture-backed telecom and semiconductor startups, where he was instrumental in fundraising, launching products, and developing technology. Gabriel's early experience working a summer job at Yellowstone National Park and for Greenpeace sparked his lifelong commitment to fighting climate change. Welcome, gentlemen.
Thank you.
Thank you.
So I wanted to highlight a topic that was cited by two pretty advanced CEOs in two of the sessions. It was Lonza Tech and Boston Metal. They've both successfully raised past Series A, and they both mentioned this concept of value of death, which spans from initial pilot to full commercialization. How do founders navigate this challenge in climate tech? And do climate tech companies fundamentally need more time and capital?
Who do you want to go first?
Go for it, Gabriel.
Yeah, Gabriel looks like he's itching to answer.
Well, I think it's funny. Lonza Tech and Boston Metal, the two you just cited, and such an interesting contrast, because when Jennifer started Lonza Tech and got that going, it was just such a different capital raising environment for companies like hers. And I think actually Boston Metal and Lonza Tech are great sort of reasonable comps, like two companies at different points in time. You want to get through that valley of death. We were having a chat. I won't steal anybody's thunder. What I kind of jotted down is you need a really big market. You need to be going after something that's bigger than $10 billion as your market, hopefully much bigger. You need, something, you got some scalable technology and revenue, that, to demonstrate that you've got some traction there. So now you've got demonstrable product market fit, real demand from your customers. And if you then tack on like a proprietary and unique solution, and I think both Lonza Tech and Boston Metal are great examples of that, you're not really going to have trouble now. Back when Jennifer started Lonza Tech, I think it was so much harder. Like the fundraising environment was so much more difficult. So my hat is off to what she has accomplished at that company, which is not at all to belittle what Tadeo is doing at Boston Metal. But you put together those ingredients. How you eventually build your capital formation stack is still super important, because you don't want to just do everything on equity. But the money is there, and it is a great time to come out with big ideas. And I think both of those companies just demonstrate that mix of those four factors. So could keep babbling, but I'll pause there and maybe let somebody else comment.
When I think about the valley of death, you could really argue there's a few different ways to approach that. Part of it is you have to get a technology working, and there's increasingly people that are good at financing and funding those. And then there's, once you prove a technology works, how do you commercialize it? And there's really people who are good at financing, funding that. And then once it's commercialized, you have to figure out how to really scale it and deploy it more meaningfully. And there's people who, are good at that. And I think one thing that's very different now than it may have been when many of us were working in this 10 years ago, where that wasn't fully developed. You didn't have all of those pieces together. And so because of that, it was really hard to find the right fit for the right stage and the right company. And I think as an industry, we've made a lot of progress. We still have a lot to do. I mean, we're not as well developed as some of the other areas, but I do think we're increasingly finding that. And I think it's important for people to recognize where they are and make sure they're spending time with the right kind of investor.
I think that pretty much leads to Scott.
Sorry, picking up on that, I think you both said really astute points that I wouldn't disagree with at all. Gabriel talking about the characteristics of the companies that are necessary to sort of, commercialize and scale, and Jeff, you talking about the ecosystem that has really developed substantially over the last 10 years so that there is more support for these companies that are moving along that life cycle. And I would just double down on the point you made at the end, Jeff, which is you've got to find the right investors. These investors are partners of yours, and they are partners through good times and bad, whether you like it or not. And hopefully you like it, and hopefully the times are good. But more often than not, you're going to have bad times, and you're going to have partners you don't like anymore. And, in a time like this, where capital isn't as scarce as it has been in the past, and where innovators are really in the driver's seat for their own growth, because they have choice among capital providers, it makes it that much more important that as a founder or as an executive, you take the time to really get to know these prospective partners. And it's not just a person, although the person who is going to do your deal is absolutely more important typically than the institution. One of the things I always say to founders, but it's also true that the incentives and the mechanics behind that person within the institution are really important. And most of the investors you'll come across don't just offer that information to founders and executives. You really need to know what's driving their decision-making, what's driving their professional developments, what's driving their compensation, in order to really understand how they're going to be in those situations that you will inevitably confront together as partners. And so I think founders and executives tend to spend a lot less time thinking about who is on their cap table and what the incentives are of those various partners, probably because we're all so busy trying to grow our business and we think capital is just fuel. It's a real mistake to think capital is just fuel. And it's a real mistake to think that capital is all you're getting as part of a partnership with an investor. You're getting a lot more, hopefully a lot of good things that you need to help you grow and succeed. But that one investment that these guys are going to make in you is not the only time you're going to be dealing with them. It's not the only time you're going to need them. And hopefully they can provide more than just that one point source of fuel for your growth.
Yeah, that definitely concurs with what Jennifer at Lonza Tech and Tedu at Boston Metal recommended. I think they recommended getting both investors that are dedicated to climate tech or clean tech, patient capital, like some of you are single balance sheet funds, but also industry strategics. So I guess, the three of you have established track record or patient capital. How do founders assess if a newcomer investor or a fund is a good partner? Or just a tourist?
I think there are a lot of tourists right now, and it's important for founders to be aware of that. But some of the tourists actually could be very value added because they could bring important skills and experiences from other industries that will be instructive as we build our companies in these industries of sustainability. Most of them, though, I think are unprepared for some of the important industry structure dynamics that exist in sustainability and in the sectors that we talk about for sustainability. In our case at Generate, we talk about energy, we talk about transportation, we talk about agriculture, we talk about waste and water. These are sectors that move more slowly, have much more infrastructure already built that you're trying to address as an entrepreneur or as a disruptor. And it's totally different from providing something brand new into a consumer base that is waiting for brand new things and rotating their purchasing, every year and a half, 2 years, like you have with consumer technologies. It's just fundamentally different. So we saw the impact of what we call Silicon Valley retreads in the clean tech 1.0 boom. I was one of them, right? I was a software entrepreneur and a venture capitalist before I became an energy and climate person. But we saw all of these semiconductor people who thought that solar was just another semiconductor. And boy, did they blow a huge hole in the ground with their investments most of the time. So it really does require domain knowledge. And I think what you said about patient capital is critical. Many of the companies in sustainability are really going to have a long time scale. And you're talking right now, Gwen, to 3 people who have genuinely long time scales. And that's about the incentives I was talking about before. We have permanent capital. We are not looking to sell. We don't have to sell. We never have to liquidate. And that is true about my fellow panelists in ways that really are unique in the world of innovation finance.
Yeah, I was just going to say, I think that one of the things Scott said is really important. And I think when you think about some people who are more recently coming to this, I mean, we need more investors, we need more capital, we need to scale the right kinds of companies. I think what people can really look for is what domain knowledge are people bringing that's relevant to what they're trying to do. Because if you look, there are new areas of innovation in deep industrial decarbonization where, certain people who really understand those industries are coming over and genuinely want to achieve decarbonization in them. And that's fantastic. If you really look at where things have failed, it's where, you don't understand the industry. And when you don't understand these complicated, difficult industries, you get chewed up by them. And I think that's really the learnings of a lot of us. I mean, look, I was a software person before this too, but, I've now, 13, 14 years, you see a lot, and you see a lot, early on that didn't work because everybody was figuring it out. And now I think there's a group of people that have seen that and understand more about what works and what doesn't. And if people coming in bring domain knowledge, that's hugely valuable. And I do think that, I mean, there's only so many people who have, the luxury of permanent capital vehicles and things like that. I do think it allows you to be well aligned, but the most important thing is just really aligning your expectations with your investors and make sure you're all on the same page about what you're trying to accomplish.
So I'm going to shake it up a little bit because I agree with a lot of what Jeff and Scott just said, domain knowledge and longer time horizons. We have capital that is certainly long duration capital when it calls for it. I am not patient capital. I hate that phrase, right? I am not patient. The problems we're going after and the things we're trying to solve, climate change, right? This is about climate change. We're not patient. I'm not patient. Sorry. We don't have till 2030 to start building these companies. We have to do it yesterday, right? So scratch that from your mindset when you're thinking about me, and I see Scott nodding. Like it's a useful phrase. I don't like it. I think things are different now from when they were 10 years ago, right? So we got a lot more people. I'll start with the most important thing. We got a lot more people, both on the entrepreneurship side and on the investor side, who are a lot more experienced and know these things. This stuff is in our DNA now. But what else is different? We got cheaper inputs, right? Like electricity, renewable electricity. After the past 10 years, we can do things with that. We've got better building block technologies. I could rattle them off in bio and materials and whatever, and computers, AI. We've got better materials to solve these problems, or we're working on them. Think about steel and cement as that's what today I was working on the steel side. We got some cement companies. So like all these building blocks are there. We've got, like climate tech's a little bit sexy. Like, let's take advantage of that. Maybe present company accepted, excuse me, but like it's fashionable. It's important. People want it and want to be a part of it. And then, Jeff was talking about, we've got money now across the landscape. So like my advice to the entrepreneurs is go out, figure it out, and go get it, because it won't always be this way. There will be a recession, there will be a war, there will be something bad. But right now it's a moment, and let's not be patient. Let's be really aggressive.
Amen.
Really great points. So I know Gabriel mentioned legacy industries, and I actually want to flag that question to Jeff and then Scott. So Jeff, you mentioned that legacy industries won't change overnight, but we can't give them a pass. So it is critical that we involve them in the transition rather than making it somebody else's problem. Any thoughts on sort of how to get legacy industries involved?
Well, I mean, you see across the board legacy industries wanting to get involved and recognizing that this is the future. I mean, we have a portfolio that has a number of these companies in them at Temasek, and we made a strategic choice to really shoulder into working on those brown to green strategies, and it's hard work. I mean, in some ways, it would be really convenient to get rid of them and say, look how green our portfolio is, but like that doesn't solve the problem. Solving the problem is doing the work to figure out how to make, an airline green, how to make heavy industry green, how to do that. And I wake up almost every day thinking about the 10 years of carbon budget we have left, and how can we move faster, and what's everything we can do to make that happen. And so, I think for me, that's my personal North Star about what I want to work on. And, as a firm, I think we're doing a lot to tackle all of those kinds of problems. And so, I think it takes, all of us as a community to keep the pressure on, keep creating opportunities, connecting the right entrepreneurs to the right companies, and pushing hard, and not forgetting the fact that this is really the most important thing we could be working on right now.
And Scott,
I think that those are all really good points, Jeff, and I'll just put a little math on it for context. We have about $40 trillion of fossil fuel infrastructure in the ground today. And the UN is calling for a clean trillion. Right. Just think about that for a minute, right? We need a lot more than $1 trillion to go into solving the problem. And a lot of it's going to come from those legacy industries. So, when I did that work at McKinsey starting in 2007, a lot of our clients, as you might expect, were legacy industry clients. And actually, many of them saw the economic opportunity that many of these resource efficiency solutions provide for them to increase the top line or the bottom line in their businesses. And they took a lot of that low-hanging fruit and genuinely had a pretty significant impact, arguably far more impact than the venture industry and the venture startups had in that period of time, because venture hadn't figured out how to start and scale companies. And these folks who were making investments like Dow Chemical, making a $2 billion investment in energy efficiency, generating close to $10 billion worth of bottom line gains, is a heck of an impact on the energy equation that I bet Silicon Valley didn't even approach in total at that period of time. But it is also true that we need to scale these new fully green solutions and spaces and disrupt the heck out of those fossil fuels if we're going to get to something more than $1 trillion a year of investment in the solutions.
Yep. A lot of this, I think a lot of people miss the base effect of the legacy industries. Gabriel, anything to add on this topic?
I could go off on a couple of rants. I'd love to point out, I'd love to hear Scott apply the math of, the trillion and 40, like the lunacy of complaining about what's essentially $350 billion a year, and what is the small number that's the CEPP, that we can't afford to do that. The lunacy of policy conversations going on right now when we think about what we need to invest. With regards to legacy industries, I work with a lot of venture groups and big oil and gas majors, and some of them are both close friends and colleagues on boards and co-investments. On the other hand, I think we need to be cautious about too close an embrace, because some of those same oil and gas majors like to tout, on the one hand, how renewables are the biggest growing or the fastest growing portion of their business. But, if something's growing from 1% to 3% of a company that's still investing 10 or $20 billion in oil exploration projects, we have to look at that company as a dubious partner. So I work with them closely. I embrace them as partners. I still think when we're solving a problem, that when we're tackling the climate problem that we're trying to tackle, we got to be eyes wide open about what their, what somebody said earlier about what are their true financial motivations. A lot of those people are still financially motivated by something that's really bad for the planet.
So I think Gabe and Scott both mentioned, you got to know the true motives of your partners, whether it's a VC partner or a corporate partner. How do you suss that out as a founder, especially if in early stage, right? You haven't gone through a couple of rounds of fundraising such that you've built scars.
I'll start because it's easy from where I sit, right? Like, just look at my term sheet. I'm going to make money when the entrepreneur makes money, and I'm not building in a lot of protections and downsides, downside protections in case things go south, right? Like, an early stage venture, it's easier for me. Like, I have one point where I'm not 100% aligned with the entrepreneur, really, which is when we're negotiating the terms of the deal. I want to pay less. She wants me to pay more. Fine, okay. Then we're aligned. We want to build a really big, profitable company. And so it's easier, but you can look for those same clues wherever you go. And I think it gets more complicated at later stages. But I know I love, we're partners with Jeff and Temasek, and I love what Scott's doing. He's created so much value for his partners and for his firm. So I'll let them speak for themselves.
Scott?
Well, I would just say, take the time. I mean, be as rigorously analytical about your partners as you are about your customers, your market. And so that means doing things like spending the time face to face with those people, perhaps with their families, oftentimes, calling people that have worked with them in the past and really making sure you understand what did go well and what didn't go well. And I think at the end of the day, I would look for a level of self-awareness in your partner. And if you feel like there's a curiosity in that other human being, you're likely to get a level of openness. You're likely to get a level of transparency. You're likely to learn what you need. And if that person is not as open, that's a pretty big red flag.
It's a great answer, Scott.
The other thing I think I would add is just, you're really, obviously getting to know, a person and ultimately getting clear on mutual expectations. What do you expect out of that person? Did they say they're going to deliver on strategic value? If so, diligence that, try to understand that. I mean, are they an early stage investor that's not going to be there later? Okay, that's fine. Just be clear on where they're going to support you and where they're not. I think for us at Temasek, I mean, because of our kind of balance sheet and the way we do things, I mean, when we get involved, our expectation is that we want to be there, throughout and support companies through going public and after. Doesn't mean we always do, but I think that is what our general kind of feeling is, and that's just a function of kind of who we are and what we have, and I just as long as people know what they're getting, that's really important. I think a lot of people can not spend the time to get that right or make assumptions that might not really be there.
So I want to end the session giving all three of you a chance to talk about your fund, what you look for in founders, what are the signs that the founders are not quite ready to talk to you, and what your views are for climate tech now that we have a more vibrant ecosystem.
So I'll go first. Since nobody's leaning forward, I'll take the mantle. But Generate is not a fund. First of all, we're a balance sheet based business, so we can provide any kind of capital in the company or in the projects. Corporate equity, corporate debt, project equity, project debt, mezzanine financing, tax financing, all of the things that our entrepreneur partners need to grow their business. And you don't have to go to 11 different audiences with 11 separate data rooms, financial models, trust building exercises, reference checking, and family meetings like I was just talking about as you evaluate them as partners. So our view is that if you have product market fit, you have customer demand, you have good economic value proposition to the customers, we're going to be able to find a way to help you. And we are probably going to find lots of ways to help you, not just with capital, but with access to customers and with access to regulatory influence, with access to talent that a lot of VCs often have promised in the past, but we have built a whole business to deliver on. So we have 2,000 customers that depend on us for decarbonization, for resilience, for cost savings, and they're eager to get more. they're eager to do more. And that's why partners want to work with us. That's why the technology companies and the project developers who have these innovative solutions are looking to work with us so that they can access those customers more quickly. At the end of the day, every CFO needs access to capital and every CEO needs access to customers. And so we built our entire business to solve both of those problems for these entrepreneurs.
Maybe about Temasek. I mean, it's a very large permanent capital vehicle headquartered in Singapore. I think the interesting thing about this platform and what we're doing is we have multiple different pockets of capital and relationships that we're building to support companies at multiple stages. We're not seed stage, very early stage investors, but we are building a strategic development team to do earlier deep tech investing, and we've started to really execute behind that. We specifically around climate investing are standing up a JV with BlackRock called Decarbonization Partners that will do growth investing. We were a anchor investor in the new Brookfield Global Transition Fund. We are setting up a new carbon credit trading operation in Singapore called the Climate Impact X. We're going to be investing in projects around that. So, we are investing other kinds of capital in companies really across the spectrum. So, we are a kind of broad growth investor with strategies across the space to work with companies. And, global, I think our biggest challenge in some ways is really about, focusing and prioritizing. And so, a lot of the work right now is trying to really identify the areas that we want to spend the most time in, really focusing in first on this question of where can we have the most carbon impact, and using that as a way to start to curate the way we think about the world, and then go back and make sure that obviously meets the appropriate risk-adjusted returns that we need to see. But when you kind of start with a perspective on impact, it really helps you frame an opportunity set differently than you would if that wasn't where you started.
Great. That's. I'll jump in. I'm gonna end. Excuse me. I'm stammering a bit. I'm so excited. I'm gonna end where I started. What are we looking for? We've been doing this for 12 years. We're looking for solutions that are going to scale, that are going to help solve climate. We were doing climate tech before somebody thought of that idea. That I can't remember who came up with that phrase. Brilliant. But climate tech, we were doing it. We've been doing it for the past 12 years. And I think we have, a lot of knowledge and experience in that. We're looking for bold, visionary entrepreneurs, whether they're first time or repeat CEOs, who have, a vision to go after a really big market. This is what I said at the start, a really big market with a scalable technology, that where they can go after and demonstrate a really good product market fit with demand for customers. The result has to be affecting climate positively. That doesn't mean that's always what you're selling. Like you're selling some sort of economic value proposition to a customer. You're selling something that a consumer really wants and generating consumer demand. It doesn't mean you're selling climate. It means that's your effect. So we're looking for entrepreneurs who have that vision. And you ask Gwen, when is it too early or too late to talk to us? Never. It's never too early. I think the worst advice entrepreneurs sometimes get is, don't go talk to that firm. You're too early for them. So what? So then you developed a relationship, and when it was the right time, you knew the partner, you knew the person, you knew the firm, and maybe you're going to be surprised. Maybe you're going to surprise them. So I think it's never too early and it's never too late. And I think that's generally true, not just of Prelude, but across the board. So
yeah, I would double down on that
there.
Sorry, Gabriel. I would double down on the last point. I think it was such a good one. You have to build trust. That's what we've been talking about really throughout this entire panel, whether it's an entrepreneur building trust with an investor or the other way around. Yeah, right. And trust isn't built in one meeting. And it's certainly not built in one Zoom call. So, we have to think about how to build trust both ways, because that's what propels relationships to succeed. And for us to have the success that we need in the short time frame that we have, as Gabriel outlined, we really need to build those trusted relationships quickly and deliberately.
And it's what rescues or keeps a company alive in the hard times, right? Like it's when I can look you in the eye and say, you got this? Okay, I'm going to wire, like I'm doing this on faith and promise and the last couple of years, 3 years, 5 years of relationship, and hopefully it doesn't come to that, right? But sometimes it does. And that's to the partnership thing Scott was talking about earlier.
Yeah.
And it sounded like George Bush, that partnership thing, the older one, not the younger one.
Well, I think the trust part was a great point to end on. It's exactly what Lonza Tech and Boston Metal both mentioned, is that you have to find great partners, investment partners that will stick by you during the lean times. Thank you guys for a great panel.
Thank you, Gwen.
It's fun. Thanks, Gwen.